it is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. And if past as prologue, one would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line to speculate that the silver price could go up 600%.
Something extraordinary is brewing in the precious metals market. And if you're stacking silver or holding gold, you need to hear this. According to Rick Rule, the silver futures market is now operating with 200 to 1 leverage, meaning that for every ounce of real silver that actually exists, there are roughly 200 paper claims trading against it. That's not 200%. That's 200 times. We're looking at a system built almost entirely on promises. And when trust cracks, those promises collapse fast. The bullion banks know this, and Rule warns they're preparing to crush silver stackers before the dam breaks. But the question is, will this backfire and send silver soaring far beyond gold?
Let's not worry for a second about the exchange traded derivatives, the ETFs, the Sprott physical products, because I
We'll
think
get
those
there.
are accounted for in the silver market. The claims that have always bothered me are the claims in the futures market. It is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. Now, virtually all of those claims, until very recently, cash settled, which is to say they weren't held for maturity. They were rolled over, whatever happened. Very recently, because of location disparities, which is to say the London market not having enough gold, there was a location premium for gold in London. And what that meant was futures holders in the US would actually take delivery of the physical silver and ship it to London to take advantage of as much as a 4% disparity in the London quote and the Chicago quote that was contemporaneous. A 1 day 4% premium. When that happened, the gold lease rates in the United States skyrocketed because rather than leasing gold, it was easy to make 2 or 3 or 4% simply shipping that gold to London. What has always scared me was an imbalance between supply and demand, between the physical gold and that paper gold, if more people stood for delivery. Make no mistake, Michelle, if you have a real imbalance in the futures market, you are not going to engineer the massive short squeeze that the silver people hope for. What the exchange will do is that they will halt silver trading. They will set an arbitrary price between buyers and sellers, and they will cash settle. That's what will happen. The exchanges run for the exchange members' benefit. That notwithstanding, that sort of market turmoil, what is likely to be the agreed upon cash settlement price, were that shortage to occur, I think would likely be dramatically higher in the circumstance that we see today than the price is today. And the dislocation in a market where 200 times the claims, where there are 200 times the claims relative to the amount available to settle on a daily basis, is a market that's really, really, really ripe for disruption.
When you say 200 times, you're saying there Is that like a 200 to 1 ratio?
Yes. Now, that doesn't happen every day, but there are days when if you look at the physical silver available uh, in North American futures markets on the COMEX as an example, good delivery silver in system available for the settlement of the claims, it is not unheard of to have 200 times that amount of silver traded in contracts on a daily basis. Now, the huge majority of those things cash settle. They aren't
Mhm.
presented for delivery. But in a situation where you have these goofy location swaps, 4% difference in spot price between London and Chicago, it's very tempting to take delivery, ship it, and grab the money. So all of a sudden, you had a situation where uh, the held for delivery proportion of those trades relative to the cash settlement portion of those trades went up, and the COMEX got stressed. I'm sure that your channel's employer, has also seen a remarkable shortage of small denomination physical silver products, the 1 ounce products, the 10-ounce products. We've noticed at Sprott that there is no shortage of silver available to us in good delivery in wholesale quantities. In other words, the bullion banks have been able to supply Sprott with the physical silver that they need. But the dealers have had a very difficult time keeping retail denominations in stock. They've also had a very difficult time hedging their silver inventories and leasing silver inventories to make available inventory to their clients on a short-term basis. There's been a dramatic turmoil in the silver market. Your own sponsor being one of the few that seems to have been able to stick handle their way through this crisis in good order and service their clients. I've never understood it, first of all. The idea that the price of a substance should be dependent on its relative abundance or scarcity in the Earth's surface doesn't make any sense to me. It's a good way to generate commissions or sell newsletters, but that ratio doesn't go to utility. It doesn't go to production cost. It doesn't go to stock versus float. The idea that silver should be, or that gold should be 16 times more valuable than silver because silver is 16 times more abundant in the Earth's surface.
Rick Rule's message is blunt. The silver market today is one of the most dangerously leveraged in the world. Each day, contracts representing hundreds of millions of ounces are traded on futures exchanges like COMEX, even though the amount of physical silver available for delivery is only a tiny fraction of that total. He explains that if gold rises around 300% during this bull cycle, a target many analysts now see as realistic, silver could surge by as much as 600%, historically outpacing gold 2 to 1 whenever metals break out together. But Rule also issues a sobering warning. The exchange system isn't built for retail investors. It's built to protect the banks. If physical delivery demands suddenly spike, the exchange will likely halt trading, cash settle contracts, and set a fixed price instead of letting a short squeeze unfold naturally. In short, retail traders may never see the fireworks they expect. He describes how recent location premiums between London and Chicago, as high as 4%, have encouraged traders to physically ship metal overseas, tightening supply even further. And while big institutions like Sprott still find good delivery silver in large bars, smaller dealers are running dry. Retail products like 1 ounce and 10-ounce bars are increasingly scarce, highlighting the stress between paper markets and the real physical one. Adding to this, current global events are amplifying the imbalance. Central banks continue hoarding gold at record levels while moving reserves between London and the US, straining available supply. Silver inventories at the LBMA and COMEX remain near multi-year lows, with analysts warning of a potential London squeeze that could push prices towards $60 to $65 per ounce in coming years. Industrial demand, from solar panels to EV batteries, is hitting record highs, just as new mine output is stagnating. Rick Rule also takes aim at popular myths. He dismisses the idea that silver's value should be tied to how abundant it is in the Earth's crust compared with gold. What matters, he says, is utility, liquidity, and investor psychology. And silver, being more volatile and affordable, tends to explode higher once gold draws mainstream attention. Finally, he reminds investors that manipulation is part of every major market, from LIBOR to treasuries, and that silver's extreme leverage makes it particularly easy to push around in the short term. But for long-term investors, the noise doesn't matter. Rule thinks in 4 to 5 year horizons, believing that when generalist investors enter the sector, silver will decouple from gold and move twice as fast, just as it did in every major bull market since the 1970s.
Doesn't explain much to me. People pay a lot of attention to it, and I think it's actually become a factoid. I think that when people quote that number, they actually impact the market's perception and the market's action. I'm just not sure why the statistic is valuable. Silver is, as far as I know, the most volatile, highly valuable commodity on the planet. Uh, the ratios, at least when I monitored for gold, were much less extreme because gold, although volatile, is nowhere near as volatile as silver. And the time premiums and the volatility premiums in futures markets for other materials seems to be nowhere near as extreme as it is in the silver market. There was also, I think, for 40 years probably, an institutional bias that the silver price was declining, while there was a popular bias that the silver price was increasing. So you had a natural war between buyers and sellers on the COMEX. I think that the institutional bias is much less likely to be short now than it used to be. And perhaps as a consequence of that, the volatility will die down. But in direct answer to the question, I don't know of any other commodity in the planet that had the mismatch between the claims volume, which is to say the futures volume, and the amount available for good delivery. Well, the manipulators can only go so long. It is alleged that in my youth, I constructed several short squeezes. Those are short-term phenomenon. I'm not somebody who believes that there's been a 30 or 40-year thoroughgoing conspiracy to depress the price of silver. You didn't have to do it because most of the time the price of silver was going down. Why would you strive mightily to do something that was going to happen via gravity? But I know that all markets in the near term are manipulated. The LIBOR market has been manipulated. The U.S. Treasury market has been manipulated. Those are much larger markets than the silver market. And in a market where the futures volume is so large relative to the amount available for good delivery, near-term market manipulation, albeit expensive, is really ludicrously easy. If you were going to do it on the short side, you construct a short ladder in the futures market, 3 months, 6 months, 12 months, 18 months, something like that. You develop a good size short position. For fun, we'll call it $1 billion. You borrow a bunch of physical silver and you sell that physical silver as aggressively as you can during the most illiquid part of the trading day, attempting, as an example, to drive down the silver price 3%, 4%, 5%, and have that precipitous decline in the physical market impact the quotes in the futures market. Cover your shorts on lock limit down days, pay back the silver that you owned, and walk away with a profit. I remember in the decade of the 70s where there was allegations that exactly that same type of manipulation happened on the long side. Manipulators generally do what's easiest. If there's a negative bias, they try to manipulate on the downside. If there's a positive bias, they try to manipulate on the upside. But the idea that silver markets aren't in the near term manipulated is extremely naive. The reason why one would invest in silver is because you don't care much about the noise, the trading noise in the near term. If you believe, as an example, like Rick Rule, that the nominal price of gold has a threefold upside, what happens next Friday is of very little consequence to your belief. Uh, to me, the intraday, frankly, the inter-month price moves are irrelevant. I'm thinking in 4-year terms, 5-year times, and I'm thinking in terms of quantum moves.
Hmm.
Difference for me, um, between $40 and $42 is absolutely inconsequential. It just absolutely doesn't matter. And I would argue that most speculators who think that they can outguess the bullion banks or the big financial syndicates, short syndicates, are delusional. In my experience, Michelle, at some point in time in a precious metals bull market, when the generalist comes into the market, I think we're just seeing that now, silver begins to outpace gold. Please don't ask me why, because I don't know. I just don't. I just know that. Perhaps it's the lower unit price. But in the three precious metals bull markets that I've lived through, at some point in time, silver decouples from gold. Perhaps we've seen that in the last 4 weeks. And when that happens, for a time at least, the the silver price seems to move twice as fast as the gold price. I need to say that that's not how I invest or speculate anymore. I own physical precious metals to maintain my purchasing power rather than to speculate or to make money. But there's a whole different class of investors than I who could be expected to be attracted to the volatility and favor silver over gold.
So here's the question for every investor watching. If the silver market is leveraged 200 to 1, what happens when that leverage finally snaps? Do we see a controlled cash settlement bailout or a full-blown repricing of silver to reflect its real scarcity? And will this next metals bull run truly send silver soaring 600% as Rick Rule believes? Or will the paper markets bury it again under manipulation and leverage? Drop your thoughts in the comments. I want to hear where you stand. And if you value insights like this, make sure to subscribe, tap the bell icon, and join our growing community here on Macro Edge, where we decode the truth behind gold, silver, and the global financial system before the headlines catch up. Thanks for watching. Stay sharp, stay informed, and I'll see you in the next one.